Hi, everyone. Barry McGuire here for Barry McGuire's Creative Real Estate Education Series. We are the Monday main event. We are live at 5. It's a day when we talk about all things real estate, mostly creative real estate, and your creative real estate business. You know, we have mortgages. We have experts on who talk about mortgages, tax, insurance. We do investor spotlight, and we have a few of those coming up. Interesting individual conversations with investors and deals they've gotten into or want to get out of or think they might like to get into. As you know, we do focus workshops, both live and virtual, that really, what do? They help you turn your creative strategies into real deals and real win-win deals. So if you want more information on any of those focus workshops, go to barrymcguire.ca and check out those workshops, as well as Tales from the Trenches, one of my favorites, stories about investors and what they are doing. Today we have as our guest Kelly Hoy. Kelly's a chartered professional accountant, a CA, and he was on the program last year, I think. Last year. Accountants are an incredible and necessary part of your team. You've got to have an accountant who knows what they are doing, and that's why we have Kelly on, because he does understand real estate and creative real estate. He has a lot of clients who are in the real estate game. So he's not just a guy who knows about it from school. He's got clients who are doing things. So we're going to be joined by Neil Taniguchi as well from his redoubt in the sunny South. Neil's kind enough to come along and participate, one of our focus team leaders. So let us bring in Kelly and Neil. And we're going to start with Kelly. Kelly, thanks for being here. Better than being outside, I know, on this icy, snowy skating rink day that we're having here in Edmonton. So thanks for coming aboard here.
Thank you.
Let's get a bit of your background. So you're a chartered professional accountant, and just by the way, when you say, "Hi, I'm Kelly," do you say I'm a chartered professional accountant? Do you say I'm a CA? Do you use both of them? What should we use? What should we designate?
We should be using both of them, and it was a bit of a transition period to come and start saying CPA after being CA for so long. But you know, we like to use both of them. So I would use CPA right now when I'm introducing myself, and then CA after that.
Okay. So Kelly is a chartered professional accountant.
Thank you.
So I'd like to get a bit of your background. Where you went to school, you articled, you got your CA, now CPA.
Yeah.
And then where did you land after that? And give us the sort of timeline to get you where you are now.
Yeah, so it starts off with the university degree, Bachelor of Commerce and Accounting, then went and articled with an international accounting firm, a Big Four firm. That's kind of the common thing to do where you don't know exactly where you want to land. Figured out after that Edmonton is what I love. I love to be here. So Edmonton's a small business community. So when I worked with a local firm for a number of years before starting my own firm, it'll be about 7 years ago now that we started our own firm. So from there, you just kind of fall into real estate. I think you start to meet a number of folks who are doing that, and the client base sort of grows in this area. So it's just something you do over and over again. And some of the concepts, some of the language that the clients speak, you're able to kind of speak back to them about it in their terms and help them to understand it.
I think that's great. That's important for it to, it's important for client comfort. If client comes and says, "Kelly, I got to do this VTB and I want to know the tax consequences." Well, Kelly knows a VTB is a vendor take back mortgage, and it doesn't have to go saying VTB. Don't give me these acronymic discussions, comments. So you're running your own firm. You've got real estate clients. Let's have and there's other things to talk about today, but I want to start with something we talked about last time, but we have to talk about again, because the question comes up all the time. Every new investor, real estate investor for sure, seems to want the answer to the question, how should I set up a structure for investing in real estate? Or they say, should I incorporate? That's what they say. So when people ask me that question, I say, the issue of structure is usually a cooperative venture between your accountant and your lawyer. And so I mostly recommend to clients that they have a chat with their accountant. And hopefully it's an accountant who is already working for them, who knows who they are, understands probably their short, medium, long-term plan for not only investing in real estate, but life and investing generally. And I say, go talk to your accountant, because you have to talk to him about what you think you're going to do in real estate and have a good word with him. And usually at the end of that process, your accountant and I will have a conversation about your structure. Should you incorporate? Should you stay as a sole proprietorship? So that's what I say to them. And I mean, does that fit for you, or do you say, go see the lawyer first?
It's definitely a collaborative process. And I think you hit the nail on the head when you talk about that discussion. And I think earlier on, we as accountants, were coming at it from a tax standpoint, and the decision about whether or not to incorporate, we don't automatically say, hey, there's going to be a big tax win to do this, but there might be other things going on with their portfolio that may make them want to incorporate, maybe commercial reasons that they may want to incorporate, maybe some liability type reasons that they may want to incorporate. It may help them to better raise money and partner if they incorporate. So the discussion is actually a fairly long and involved one, and I think it's the investor being inquisitive is really important in terms of having that discussion.
Yeah, they have to want to know, and they want to be able to, they have to want to know, to understand what's going on and why they should be doing things. And there are a lot of things to talk about. I mean, I have to think there's a big difference from your end of things, whether someone comes in and says, all right, I've got a 9-to-5 job. It spits off reasonable amount of money. I don't own any properties yet. I might be able to buy a property every 5 years if I work hard and save my money. I'd like to get 3 properties, probably pay them off, and that's going to be my limit. Yeah. That's one guy. There's another guy who says, well, I've been banging away on it for a few years. I got 10 properties now. I've got a little business that spits off some money, not too much. Right. And I'm kind of waffling about heading into the multifamily area, because all my properties are single family, or maybe houses with suites, duplexes with suites. Or somebody comes along and says, I've been a successful businessman. My business throws off wads of cash. And, I want to dip my toe in the real estate area. I'm probably going to start out in multifamily. I mean, we've got no experience and no properties, right up to I'm going to dive right in up to my neck, and I've got lots of cash. So maybe you can just run us through those 3 scenarios. I appreciate that's all you know about your client is what I've just said.
Yeah. But yeah, and I think, like, to just kind of caveat it a little bit, they're all kind of individual circumstances. So the depth of discussion between the accountant and lawyer may generate a different result based off of that initial fact pattern than what we would come to think. So I think what we would come to think off the hop for the first investor who's working that 9-to-5, earning a reasonable amount of income, they've got an investment portfolio that may include rental property, other investments, and they're looking to maybe own three rental properties throughout the tenure of their ownership, just go and pay them down. And that's the classic example of just holding them in your personal name, talking to your lawyer about the risks and advantages of doing that, and just keeping your life simple, treating it really like an investment. That's definitely the classic slam dunk personal example. The third example with the business owner, they probably have a lot of wealth that they have within their corporation that they've paid the small business tax rate on. So here in Alberta, we're looking at an 11% tax rate on that. So that's sort of more the classic example of using those funds as a down payment within a corporate umbrella towards that multifamily investment, and having a deferral of tax by paying only that 11% rather than stripping out the money and paying personal tax to fund the down payment. Obviously, a little bit more involved than that. There are now rules that can kind of hurt your small business tax rate when you've got some passive investment income. So certainly more in-depth discussion there, but that's the other end of the spectrum where you absolutely would go ahead and do it. And then that second one, like usually you have some sort of a structure beyond just personal ownership with that structure, with that long-time investor. And a lot of that's driven more commercially than tax-wise, to have that structure in place. But this is one where I think it's less the slam dunk and more of that in-depth conversation surrounding non-tax objectives as well as tax objectives.
Interesting that the middle ground, the guy who's done reasonably well in real estate and wants to do more, is the guy you really got to have that in-depth conversation with, as opposed to the two ends of the spectrum.
Yeah, it is interesting because you'd think like the really wealthy entrepreneur, man, like we've got to spend a lot of time going and digging into this. But in terms of structuring the initial investment, it may be a lot more apparent as to the way you want to go, for sure.
Yeah. To go off on a little tangent, because that's what we do on this show. Let's go on tangents. And not looking at you, Neil. Not, absolutely not. I wouldn't. No.
Where's Wayne when I need him?
Yeah, where is Wayne? When we get to the upper end of the spectrum, and somebody is really popping along and going great guns, and they're looking to get a lot of investors involved, do you get involved in the general partner, limited partner setup with its interesting tax consequences and complicated structure? Is that something you also look at?
Yeah, we certainly look at that structure, the general partner, limited partnership structure, a lot more kind of complex than sort of those more basic structures that we're talking about, and a lot more education required from an owner standpoint in terms of getting into the structure. And what we find with sort of that second tier of owner that we're talking about, that an example, even that type of a structure gets so complex that you kind of look at cost benefit wise. And at the end of the day, I don't see quite as many people kind of getting there and pulling the trigger on that structure. And maybe our practice is kind of geared towards a bit more of those mom and pop type investors, and the people sort of the 10 to 20 properties. But the LP structure is certainly one that, yeah, you think long and hard about getting into, but it certainly can make a lot of sense. But what I'm finding quite interesting is this is where it kind of goes back to that first discussion about the language. You and I could own a common investment within a corporation that we each own part of. My corporation and your corporation could own a common investment. And it may not mean that a partnership exists.
No.
And what happens quite frequently with real estate investors is that they use the word partner. And I think that word's used quite loosely. So, I mean, for me, what I wouldn't mind seeing a bit more of is that education about what is a partnership under provincial law? What is a limited partnership? And why would we, from a legal standpoint, want to use one and have something like a partnership agreement set up?
That's a good point. And we've never delved into that. I know what you mean. People say, me and my joint venture partner.
Yes.
They don't really mean a partner under the Partnership Act, and they certainly don't mean a limited partner. And running things under the Partnership Act is totally different than having a co-ownership agreement where there is no partnership, although people call themselves that. So we'll mark that down as a conversation for another time, and see if we can add a bit more education in there. Not to dispel how people speak, because I don't think we're going to make people stop saying Neil's my joint venture partner, but just to know why.
It's just you got to know when you're on the phone with the CRA and you start dropping the partner word. There's the asking of where that information return is for that partnership, and
yes.
It's just it goes back to that education piece about talking to the clients about what does this mean for you and your joint venture partner, and what does it mean for what your reporting is, because you probably have, like you say, a co-ownership agreement as an example.
Mm-hmm. Neil, you've been at this for quite a while. When did you start investing, Neil? I mean, it was before Ron LeGrand. You were into it before Ron, weren't you?
Yeah, I mean, Linda and I together bought our first rental property in 2020. I'll be okay. 2002. So we're coming up on 20 years.
Yeah.
With that, and they all started as personal buy and holds, because I'm sitting there listening to Kelly going, you know, one of those things that if you had to do it over again, the only real guidance that we received over the years was more from a tax aspect and perspective. And when I see those discussions about should I incorporate, should I not, the right answer is to seek the information from a professional accountant and a lawyer, because the accountants definitely cover here's what your tax implications are. No one ever said the word to us, hey, liability, piercing a veil, and umbrella and all that, until far later in our experience. Now, quite frankly, we didn't change much. We kept a lot of our buy and holds personally, but then we set up the corporation when we started doing some of the more creative stuff for two reasons. One, it was to try and separate the two asset classes, because we've been treating our rent-to-own type assets as inventory as opposed to buy and hold stuff as capital assets. And we actually had an accountant who went against the initial advice we were given to do that. So again, it's all about opinion. But at the end of the day, we ended up staying with that corporate structure. And again, we didn't know what we didn't know. And I think that might resonate with a bunch of the folks watching this, that as growth happens, what are the questions to ask? So that's when we, you know, if I had to do it over again, we certainly would have reached out to someone with Kelly's expertise, you know, that classification and level of expertise sooner, to say, hey, are we on the right track here? Because once you've laid out a bunch of stuff, you can always undo it, but it gets harder, right? So it was interesting because, as you saw, my internet blipped here, and so I missed, and you folks were talking about joint venture partner, and I always go, my joint venture, and I know that you tell us not to say that, and I'm sitting here listening to that, and I can't come up with the word. What's the word that I have to, when I'm removing partner out of there, our joint venture-ers? Is that right?
Yes. This is Neil. He's a joint venturer along with me, or he and I are co-owners. You can say, get rid of the word partner in there. It's, you know, folks, it's not fatal unless, as Kelly says, you're talking to the CRA and it's going to cause them to descend on you for all your failures to file actual partnership returns or things that you need to do with them. So it's not fatal. It just, it's not really descriptive of the situation, but be that as it may. So one thing that I want to ask or say is, Neil, this comes out of what you just said, which is, we just got started. We didn't know. We didn't have any advice. We bought in our personal names. And then you mentioned that you can change that sort of thing. So Kelly, one of the things I coach people on when they're getting themselves all concerned and worried about whether they have the structure right is, I say to them, it's probably way more important to get started. And we do this in our focus workshops. It's way more important to get started than be perfect. So yeah, if you want to get involved in real estate and you can't quite figure out the structure side of it, then go out and buy a property or two. Doing that without the right structure, is that going to kill somebody, Kelly?
It's not going to kill somebody. No, it's really just an investment into real estate that there's not any kind of dire consequence to starting, say, with the real estate in your personal name. And if I was kind of on the fence between the two, it's a lot easier to put a property into a corporation in the future. You can do this in a tax deferred basis, but to wind it up and take the property out, you may have a taxable event. So it's easier to put a more complex structure in place down the road. And this even goes to the question of there are investors who potentially have a property management company, or they may have a separate company that does their flips from their long-term buy and holds. So just getting started is really really a big part of it. That's for sure. And when you're getting started, you may be relying kind of more on your investigation of the real estate market and the other folks on your team than you're tax advisor, because that, if you buy the wrong property, I think there's a whole host of other non-tax issues there.
Yeah. So folks, I want you to, if you're trying to take away points from today's discussions, if you're just getting started, don't really be too worried about not having your exact forever structure in place, because as Kelly says, you can, if you start in your personal name, you can move those properties into a corporation on a tax deferred basis. Tougher going the other way. You might have a tax event if you're taking it out of a corporation, but it's really the getting started and time in the market that serves you more than being exactly right about your setup. So I think that's an important nugget to take away today. All right. So Kelly, let's talk about some of the other inquiries that you have with people. I'm sure that there are things that come up time and again. So you mentioned a couple of things that people would look at in the should I incorporate, or what should my structure be? I mean, one of them is that you have better liability protection if you purchase in a corporation. So that's that's kind of on the plus side. On the minus side, I guess you certainly have professional fees that keep your company in good standing, fees that you have to pay every year that you don't when you own personally. And
sure.
I know that my professional corporation runs me, $3,000 plus a year. And so, I've got quite a few properties, so that are in my PC. So that's kind of fine. But if you're only ever going to buy one property, you have to think about whether or not you're going to take on, or you want to take on those annual costs, which can run, easily $2,500, $3,000 between.
Certainly.
So liability, yes. If you have things in a corporation, that insulates you from personal attacks and personal responsibility. Cost can be substantial. What other things do you talk about regularly? Well, they come up a lot of times with a lot of people.
Well, that cost one is really, really important. I think we should just elaborate on that one for a minute or two. Those numbers that you're throwing out there are certainly fairly accurate. So what I really don't like to see is that, if we have a new client coming in, they've got their 3 corporations, they've got their their active business corporation, which might be their management company, they've got their holding company, and they've got their long-term hold company for properties. And by the way, they only own 2 or 3 properties, and you just kind of look at them, and that cost for that structure is really, it's almost tragic in some sense. So cost benefits really a critical thing to look at. Sometimes on the benefit side, with having the company, I have found that the investors, because you have to kind of do dual entry accounting, you have to provide the information to prepare a balance sheet and income statement. I find a lot of them will know their real estate business a little bit better. So that's another kind of area on the benefit side of things. But what really comes up to me quite a bit with folks that are new is, how do you do the record keeping for the real estate investment? I mean, if you've got a corporation, you've got to keep a good set of books. All of a sudden, this brings into play, do you hire a bookkeeping company to do that? And then how do you find one that certainly focuses on the real estate investors? So I find a lot of the questions and discussions, to me, Barry, have to do with this concept of managing the team, which is your accountant, your real estate lawyer, your realtor, financing, and bookkeeping. A lot of it has to do really with that team management perspective. And there's kind of that light bulb that goes off when the owner realizes, hey, I am in charge of managing the team. So if I don't like my accountant, I can just shift him out if I find a better alternative, or if I don't haven't got the right bookkeeping set up, I can move along as well. So I find a lot of discussions really go towards that nuts and bolts element of it. And I think the role for professional accountant, a lot of it too, is because we're having an ongoing service point every year. Just because we've had a lot of these discussions already, it's just almost you know, because of the profession, we've got confidentiality. One of those sounding boards when you're discussing your team. That's, I don't know if you find that as well with your investors when they say, hey, you know, I'm looking for a new accountant, or is this mortgage broker the right one for us? We've been with them for a number of years. I find a lot of those types of discussions are equally as important to my clients as the tax and corporate structuring discussions.
Yes, I didn't consider that you might be looking at it from that perspective, but I totally get it, that it is it's a team sport, and I guess you kind of get to see the results of who people have on their team as you sit down with them and look at the shoebox that they brought in that they expect you to make sense of, or you're looking at some financing, which you can tell because you've seen quite a few setups that they're paying way more than they should. So,
yeah.
There's and you do have the service point every year, as you say, which my service point is when people buy a property, but
right.
If they're not buying one, I'm not seeing them every year to do a little recap, that's a great reason to have an accountant who understands real estate and who will at least once a year be going, okay, what do we got going on here? And how's it going? And are you being well served by other team? Do you have any issues? And of course, you'd have some pointed questions from what you see as they bring things to you. So I want to go back a step to your comment about corporations, and people come to see you, and they already have their corporations.
Yeah,
they've got, as you alluded to, they've got the 3-tier. They've got 3 corporations set up because they took a course where the advising guru said, you got to have this structure, got to have this, got to have the three corporations. Well,
yeah.
On the cost side, it's $1,000 or so, maybe a little more than that, in our office to set up the corporation to start
right.
with, and then you've got those $2,500, $3,000
yeah.
or more, depending, professional fees on your end every year. So if they're positive cash flow to the tune of $10 a month, but their professional fees are $10,000 a year,
right,
plus $3,000 or $4,000 setup, they're they're unnecessarily behind the 8 ball right from the get-go. So, folks, again, Kelly and I are not sitting here saying that I want the incorporation business. You got to set up some corporations because Barry needs to do some billing, and Kelly wants to add you to his long-term list of clients so he can do your corporation every year. And there's a lot to do. I mean, there's a lot to do. So this is an accountant and a lawyer saying to you, they don't want your work.
No. And sometimes it's the most rewarding thing when you see a client that's been paying their fees for a number of years that we're able to find a way to kind of collapse that structure. So, if you set the 3 companies up, and it may not be that you kind of got swindled at a course or anything, like you may have set them up with a good intention to have all of these businesses off the ground, and you might have run into, the issue with financing within the corporate umbrella. You may not be able to go and get all those properties that you want. You may have been talking to someone who may be in sort of our air quotes partner, joint venture partner, and they kind of promised you a bill of goods that you'd be able to do this exciting business with them that's not materializing. So what we look at then, what Barry and I would look at together is how do you collapse this thing? And it may be that you don't take those 3 or 4 properties out of the company and take them all personally in 1 year. There might be a big tax hit to do that, but you might do a transaction where you amalgamate all of the companies. In that instance, what I would be doing is sending a letter to the client's lawyer, whether it's Barry or another lawyer, and instructing them on some steps on how to kind of make the structure a lot simpler and lower cost for our clients. So sometimes the biggest wins that we have are, collapsing things and saving the client some fees, because really their setup is a lot simpler than maybe they thought it needed to be when they started out. That's a really good point to say that if you find yourself in a structure that's not working for you, a multi-corporation structure, as Kelly says, you can collapse some of those things, maybe end up with one corporation, amalgamate, and that might be the best accounting and legal dollars you ever spent to get back to something that's simpler and works better for you in your situation. Yeah, like, and I find like the question there from a real estate owner perspective, it's not, is my structure right or wrong? Is it does it make sense? Does it make sense to me why I have all of these companies and these accounting fees every year? Can I do, when I leave my accountant's office, like, is this something that makes sense? And you know, if the answer is yes, then you proceed with it, and the answer is no, then it's go and ask some questions until it makes sense, until it either makes sense or you collapse it.
Yeah, that's kind of a good way to look at it. I think, you know, does the proposed structure or the existing structure actually make sense for you? So that's always a discussion Kelly will be happy to have with you. Now, I'm just going to talk to my producer, Donna, here. It looks like we have a few questions, Donna.
Sure.
Do you want to organize them? Wayne organizing them? What are we going to do here?
There was a good question about...
See, Sean has nipped in here.
Bear trust. Plus and minus of a bear trust versus holdco ownership.
Plus or minus of a bear trust versus holdco ownership of a property. So, Kelly, we get this a lot. People think they're going to go incorporate, and maybe they haven't done it yet, or they have incorporated, and their intention is to purchase all their properties in their corporation, and then in order to purchase properties, they go and see their lender. They see a mortgage broker like Sean, or they go to RBC or TD and they apply for a loan, and then the conversation is had around what mortgage products can be offered to you personally at what interest rates versus what products can be offered to you corporately. And that's often a big shock for people to find that it's a whole different qualification process when you're going to borrow corporately, and it costs, you know, the interest rates can be higher and the terms tougher. So do you find that? Do you find people coming to talk to you about that, or do you see that in your practice?
I do find people coming to talk about that. And so just to clarify for everyone, the situation that Sean's describing is where the individual would be on the title of the property at Land Titles, and they would have a trust agreement in place where the corporation would be the beneficial owner of said property. And we're seeing more and more people come and ask about this. So then what you do is you say, like, are we still getting the advantages that we thought we were going to get by having the corporation in place? So if we kind of go back to our 3 example clients, the example client that's using the corporation, corporate tax dollars and not personal tax dollars from their small business to fund their down payment. I think if you had a really great tax reason to do this, then you certainly would, Sean, see that advantage to setting it up that way. But if we're kind of looking at some of those other advantages, and you talk about piercing the corporate veil or personal liability issues, I think my question always back to the client is to talk to the lawyer about, you know, if I'm personally on the title of the property, if my name personally is on the mortgage of the property, like, are these advantages that we thought we had still present with this setup? And I've heard you mention before, Barry, like something that is really incumbent upon the investor to be aware of is they may say, hey, Barry, set me up this bear trust agreement, but what does the lender say about doing that? Like that's kind of the question for me. Like, is this, you know, can you do this and not tell the lender about it? Or does their mortgage say, hey, you cannot assign this property?
Yes, and that's a very important part of any discussion around a bear trust. Mortgages are a type of contract or arrangement that require full disclosure, for sure. I mean, you should always be fully disclosing, but there's lots of case law and precedent around mortgages being really full disclosure things. So you're supposed to tell your lender everything that's going on with the mortgage and the plan and the details surrounding why you're speaking to your lender in the first place. So my coaching to clients who start talking to me about a bear trust is, have you spoken to your lender? Have you spoken to your mortgage broker? Do they understand that this is what you're looking to do? and are they okay with it? So I do ask about that, and I do say to them, if you end up using me to purchase this property, and I'm going to be the lawyer for the lender as well as for you, so you know, Kelly, that's one of the few circumstances where the Law Society allows us to act for more than one client. It's transparent, and if I'm representing the bank and I know something I think the bank wants to know, I have to tell the bank.
Right.
So let's get this out of the way right away by you having that discussion with your lender, and make sure it's upfront and that you've got approval, and that's how you do these things, or I can't be involved.
Yeah.
So.
And we do see sort of cart before the horse sometimes in this situation where you have corporations set up for the purpose and it just can't get there. So I think for me, like when we talk about setting these things up, like answering that question first before paying the $1,000 plus to set the company up is really quite important.
Yeah. And I find that too, Kelly, that folks have made the decision that they're going to buy corporately somewhere else. They didn't talk to me, and obviously they didn't talk to you. but then the deal starts showing up, and now you're having discussions about personal versus corporate, and none of the disclosure gets done, and it's very awkward. So I mean, there's nothing wrong with the Bear Trust structure if it fits for the circumstances. The Bear Trust Agreement does not have to be a 20-page document. So I'm not sure what else we want to say on the Bear Trust side of things. Pluses and minuses. Sean wants pluses and minuses. Well, I mean, one of the plus sides is you can usually do better on the mortgage product side of things. That certainly is a plus. If there's commercial and tax and other advantages to having it in the corporate structure, then that would be a plus on that side. One of the minuses, I guess, is the disclosure. I'm never quite sure that people understand what they should be saying to their lender about wanting to set it up in a Bear Trust. So I'm not always sure that gets taken care of the way it ought to get taken care of. There's perhaps the loss of liability on the minus side. If something happens in one of your properties and you are on the title and there's a lawsuit launched, all they know is you own the property, and so you're going to get smacked with the lawsuit.
Right.
Whether or not you can pass that, responsibility and actual liability over to your corporation is it's kind of a litigation matter, and every circumstance is different. So I can't really opine on that one, especially not in this kind of a venue that we've got going on now. So I mean, there's a lot of it depends.
There's a lot of it depends in Canadian tax.
I'm always shocked when I look at that tax Bible that you guys have that's written on onion skin paper. It's still 3 inches thick and 1,800 pages long.
Yep.
I mean, it's unbelievable, the nuances to tax. Unbelievable. So let's look at a different question. Thanks to Kelly for coming out. Corporations only have rental income. They're taxed at a specified business rate near 50%. Is this correct? If so, this is a huge drawback of the corporation. Is it not?
It is a huge drawback of the corporation. And I think we want to talk about specified investment business. They're taxed at a rate close to 50% until such time that the company pays dividends out to their shareholders. Then they recover a portion of that tax. So here in Alberta, we're at 46.67%, and 30.67% of that's refundable when dividends are paid to the shareholders. So putting money into the company without paying dividends out is not a huge tax one. And this is where we, as tax practitioners, used to kind of stop, and I'd have someone come in and say, hey, I want to set my rental properties up in a company. And it was just, why? Don't do that. It's 46% unless you pay dividends out to get the rate to a comparable rate than it would be if it were in your personal name. So why do that? yeah, that was kind of where we stopped. And then what happens is you kind of talk to more people in the industry, and there really are commercial reasons for setting up the corporation as an owner of the property. And that was really for me, sort of the light bulb went off just talking to a number of people who had that set up, and they just seemed to be successful investors, and they were working with potentially joint venture partners. There I use that wrong word, partner, again, because I'm already using the lingo. So that was kind of for me the point where it was a longer discussion than just no, don't do that. I think sometimes we're guilty of that no, don't do that type of a discussion. But the other thing, just to draw attention to our sort of example 3 earlier, when we're talking about that successful business owner, that maybe they're putting 25% down on their property. So if they're putting 100,000 down on their property, and if it's out of income they've paid the small business tax rate of 11% at, using those corporate dollars for the down payment definitely is a tax win. But you're right, and this is so overlooked in that sort of go set up my 3 real estate company structure. I'm excited to set the corporation up.
All right. We have a few more questions I see. Would incorporating be necessary for short-term strategies like flips, fix and flips, or wholesaling? It's not necessary, but Kelly?
But this is another area I love discussing, because a lot of times you'll get someone who's going to do a flip and they're going to maybe do one and see where it goes. So then do you set up a corporation to do one flip? And then, so what is a flip? A flip is when you buy something, fix it up and sell it, and wholesaling similar in terms of an active business operation. So when you're buying something to sell it, it's inventory. So presumably then you're undertaking an active business, and that 46.67% tax rate within the company could become the 11% tax rate here in Alberta. So setting the corporation up to have this type of a business from a tax standpoint can make a lot of sense. And this is where having a separate corporation to really clearly define what is a flip versus a long-term hold is just really quite critical to make sure that these two activities aren't mushed together and blended together. And I think too, what I talk to folks about who are looking at doing this is to sort of talk to your lawyer and see what the right thing to do is now that you're kind of undertaking effectively a construction business to buy, renovate, and sell. Is doing that in your personal name the best approach?
Yes. So there's a few things come out of this question. So dealing with your last comment first, yes, if you're running a fix and flip business, there's far more room for you to get shot at by unhappy contractors, unhappy anybody. Fix and flip is a whole other separate strategy that it takes a while to get good at. It takes a while to learn how to make money at fix and flip. There's lots and lots of mistakes to be made, but you certainly can do well at fix and flip once you learn that business. Wholesaling, again, it takes some time to learn how to do the strategy, but if you are, if you are able to successfully implement those strategies, you definitely don't want to have, this is my opinion, you don't want to have your long-term buy and hold properties in with your fix and flip and assignment situations, because if they're all mushed up and the CRA takes a sniff at these, Kelly, what's the likely reaction from the CRA when we have these various investment styles mixed up in one corporation?
Misclassification is really like, what was your intention when you bought this? So if you're trying to have something that's held on account of capital, i.e. only half of it's taxable, and they conclude it's inventory of a business on a fully distributed basis, your tax is going to be quite a bit higher. So you really don't want to be unclear with them, just as yeah, would be a poor practice to do that. And while you were kind of talking there, Barry, I was just kind of going through, and I haven't found anything up to date on CRA's or the Liberal government's plan to introduce that anti-flipping tax. So I think another issue that's really important when we talk about flipping is you sort of hear that, my neighbor just bought a place, fixed it up and flipped it, and, was claiming that it was his principal residence. So that in the election proposal, they were going to introduce some additional measures for those properties that are sold within a 12-month period. So this is just something for investors to understand. And clearly, if you're doing everything correctly, you're going to a good lawyer, you've got a good accountant, you're not going to be trying to pretend that a flip property was a principal residence. But just something for real estate investors to know, because when it finally comes down the pipeline, there may be some misconceptions about it. And really that they're going after people who are kind of lying about principal residence rather than sort of the business flippers. And if those want to look online, Jamie Gollenbeck from CIBC had a good article on this in December. Jamie's stuff's always really attainable to read. So just wanted to mention that as well.
He does write really well. I read his column in the National Post. I think he writes in the Post, maybe the Globe. I can't remember. But anyway, he's nationally syndicated, and he does write very good things. And I read him all the time, every chance I get. Gollenbeck, Jamie Gollenbeck, if anybody wants to look that up. So, just talking about the various strategies here. I subscribe to something called the Lawyers Weekly, and it's comments from one of the big providers, LexisNexis, who look at all the cases and look comments from lawyers. A recent one I read is that the CRA is looking a lot more closely at fix and flips. That folks haven't been reporting properly, and so. Sure. And so the CRA, that's one of the bugs they have in their bees in their bonnets right now is fix and flip. So if you're doing fix and flip, it's incumbent on you to make sure that you are that you have the proper structure for it, and that you're properly reporting, and that you're ready for an audit. Because when the CRA is on things, I think, Kelly, you tell me, I think what they do is they look for occurrences of fix and flips where they can audit more of them than they would normally do. How does that look to you from your end?
Yeah, this is definitely something that's been an area of focus, going back to them in 2016, having us report the sales of our principal residences on our personal tax return. In that people who do the fix and flips may not be your traditional business owner, so they may not understand exactly what they should do with their obligations. And it's just an area where there's a huge opportunity for errors. So something that could come into play is, GST. Are you a builder for GST purposes? Was it a substantial renovation such that the property is essentially a new house, and therefore does GST apply to the sale? Yeah. Or is it sort of you put your new flooring down, put your paint on, and touch up a few repairs, and it doesn't, and it's still used residential property. So this is another really big issue with fix and flip. And then it's, are you an investor? Are you in a construction business? Do you all of a sudden now have to report detail on your subcontractors to the CRA? This is something that we see quite frequently in the construction industry, that all people who own construction companies or construction businesses are required to report information on their subcontractors to the CRA. So when you start off doing a fix and flip, like, that's another issue that you want to look into. Do you have to do subcontractor reporting? So it's not something that, like, what I kind of love about real estate, like, some of the day-to-day of it in terms of filing the tax returns, it isn't that complicated, but there's sort of these little issues that spider web out and offshoot that you really need to slow down and think about. And
you need to think about them and on a regular basis. Kelly, you were talking about the government throwing out some trial balloons. What does the PM do? The mandate letters that he sends to all his ministers saying, okay, this is what we want you to do. And I think that's where the issue of taxing fix and flips more heavily or making people rent for longer and not, I mean, there's a whole bunch of stuff he threw out that may or may not show up as law. I mean, it's talk now. It's, the government's going to work that into a policy. Policies turn into laws, and laws turn into tax changes that happen on a regular basis.
Sure. And Minister of National Revenue, Diane
talked about Kelly's tax bylaw, 1,800 pages long, 3 inches thick. I mean, it changes every year, does it not? And change substantially. I mean, you can't rely on last year's deal being this year's tax preparation method.
Yeah, you really can't. And I remember back when I was doing the in-depth tax course, the first meeting we went to in person, I came with an older version of the Act, and the analysis was actually different based on me reading that older version of the Act. So I was kind of almost embarrassed in front of my colleagues that my response was not the most up-to-date version. And I think that had to do something with coffee, taxable benefits for coffee at work, or some silly little issue like this. So it is huge and certainly ever changing. And I was just going to mention Diane Leboutillier, Minister of National Revenue. You can certainly go and look up her ministerial letter. That the Minister of Finance kind of gets all the publicity, but if you want to kind of see what they're doing, to Barry's comment, you could certainly look that up. Yeah, I think we've got another question there, Barry. Did you want to jump to that?
Can we buy in personal names and transfer to a company as an investment? So we did talk about that a little bit earlier. Kelly, why don't you just tell people again how that works?
Yeah, so how that works, there's a section of the Tax Act, Section 85, which allows the taxpayer to, in general terms, transfer a property to a corporation. And effectively what they're doing is they're selling that property to the corporation for its tax cost under Section 85. So this is certainly something you can do. You have to be careful using this section, and you really have to slow down and make sure that what you understand about your property is true. So for instance, within this section, there are restrictions surrounding transferring of land that's inventory into a company. So those flip properties, if you sort of bought the flip property personally, putting that in a company later you could have some challenges with this. So this is where you'd kind of really slow down and make sure that the tax is well scoped out on this company.
Somebody says this is called a rollover, tax deferred usually. So we often call it what, Kelly, a Section 85 rollover? Is that?
We call it a Section 85 rollover. Yep, that's what we call it.
That's when you.
And that's what I like. I love that usually. Yeah.
I like it. Kind of rolls off the tongue, transferring your property in your personal name to a corporation using a Section 85 rollover.
Yeah.
All right. Another question here. Oh, somebody's put up Jamie Gollenbeck's December article.
Great.
That was Neil doing that? Good. Excellent. Okay. Who's got me a question? That's it. Come on. There's got to be more than that.
That might be good.
I thought I saw another one there.
There was one up there for a minute. I think this had to do, there's a two-year question. I didn't catch the whole question, but it had to do with.
Yeah. Are we missing a part of this? At least for 2 years when company makes enough money. No, we answered this one. Can we buy in personal name? Just did it.
This is the one.
This is the one. At least for 2 years when company makes enough money to qualify for mortgage and we have equity to show to lender. Sounds like it's an answer to a comment rather than a question.
Yeah.
All right. Well, we'll leave that one. What about Aberrant Art? What is it? He says he's new to real estate. Most of his information is from the U.S. Is there any similar platform to PropStream for Canada or any skip tracing companies for Canada that you recommend? Well, Aberrant Art, I'm kind of know what PropStream is, but I don't know if we have anything similar. And skip tracing companies, I'm not familiar with any companies. It just doesn't show up in my practice. So I'm no help to you, Art, on those ones.
I'm not too much help either on those ones. But I do find a lot of time, Barry, that, you know, we'll have a client read a US specific article based on a strategy that works there, and it may not be applicable up here. So that's why kind of what you're doing with Canadian based information is really, really quite important.
Yeah, that does come up a fair bit. I can't tell you the number of times I've had emails or calls from people who have taken a US course, and they want to use the US strategy in Canada. And it most often doesn't work because we have different legal systems in Canada and the US. And there's 50 US states, all of whom have their different subsystems. So folks, you need some Canadian education if you're going to invest in real estate in Canada. You know, you definitely do. All right, Kelly. Well, one more. Somebody answering. That's an answer to Art's question. That's good. Thanks,
Nice.
whoever did that. That's excellent. All right, I think we've run out of questions. So, Kelly, I want to know.
Yes.
Here's the big question.
Okay.
Are you taking on new clients?
Yes. Yeah, we're taking on new clients.
Kelly's taking on
Usually, like in this realm, a really good client for us maybe has a few properties already, and they're trying to decide whether they're going to implement a strategy with them. We're probably less geared towards those buying their first or second property when you're sort of on that 3 or 4 and you're implementing a strategy and thinking about different things. And I kind of refer to here in Alberta as campfire talk. What are you talking about at the campfire at the cabin? You know, your friend says he's got the 3 companies, and is that what I want to do? Like those are really good introductions.
Okay. All right. So how are folks going to get hold of you? They want to
Google.
Google Kelly Hoy, and his
that's
contact
it.
details will be there.
That's the best way. Just Google us, phone numbers up there, and get a hold of us that way.
All right.
I do serve clients in Ontario. Yes, just to answer that last.
That's good. Then
That last question.
Do you serve clients across the country?
Excluding Quebec.
Excluding Quebec, yes. Okay.
Yeah.
Different system there.
Yeah,
sure.
you've got to deal with Revenue Quebec and their specific filings. So you really want to have an expert on the ground there who deals with Revenue Quebec on an ongoing basis if you're gonna do any work out there.
All right. Last thing, I think Donna asked you if you had maybe a couple of top tips for clients that we can pass along just before we head out.
Yeah, I think the first one we hit on this a lot is to manage the team. Like, don't be afraid to make changes on the team.
Mm-hmm.
And the second one is to not be afraid to ask questions and to be inquisitive about your situation. I think really what I don't like in real estate investing is sort of a one-size-fits-all approach. You and your neighbor may have very similar investment portfolios, but could have a completely separate strategy. So it's very individual based. So asking those questions and obtaining the information would be kind of the big takeaway for me.
All right. Well, Kelly, where does an hour go? I mean, zip. There it is. Well, that's great. Thanks for coming on again.
Thanks, Barry. Appreciate it.
Even better than last time, and last time was good.
Mm-hmm.
So you can, if folks, anybody wants to rewatch this thing, this will be up on YouTube. Get hold of Kelly if you want to talk to an accountant who knows what he's doing in the real estate side of things. And Neil, thanks for showing up. I know your internet crapped out on you down there, but go have a Corona, and we enjoyed you for the time that you were here. So thanks everybody for showing up. We'll say goodbye and we'll catch up again next time. Thanks, Kelly.
Thanks.
Good night, everybody.